I'd like to welcome you all back from that break and thank the Millikan Institute for giving me the great honor of chairing this real estate panel. I was listening to CNBC earlier this morning, and they were talking about how the S&P has finally recognized real estate as a separate asset class. It is no longer part of finance, and this shows you how important real estate is. When we were talking about this panel, my panelists and I were talking about the fact that monetary policy has had a big impact on real estate. And while the absolute yields have come down on a relative basis, it is still hugely attractive. And I thought I would start out by asking Paul, who's on my far left, how he sees the impact of monetary policy on real estate. Is pricing totally artificial now? Does it reflect far more monetary policy than it reflects fundamentals?
Yeah.
Thank you.
Well, if you look at, I'll take the US maybe as an example of this. So if you look at real estate values since the crisis, we're now well above peak 2008 values in certain segments of the market. And the vast majority of that has come from capital flows rather than from fundamentals. And those capital flows are being driven by the fact that in a low yield environment, property looks attractive relative to, say, a BBB bond, which is what generally core real estate has been priced against. So if you're a relative value investor, it looks still relatively attractive. The margin on the BBB is still higher than it has been historically. If you're a fundamentals investor like I am, like we are, then it looks very concerning, because if you look at London, for example, the 20-year average yield on City of London office is 5.5% return. Is trading well below 4. So what that indicates is that we are pricing real estate on a very different way than we've traditionally thought about the risk return on that property. The one area that gives us pause and gives us concern is if we do go back to a more normal interest rate environment, and I just say if we go back, because I'm not sure that is necessarily possible anymore, but if we do go back to a more normalized interest rate environment and we start to see yields on property go back to historic norms, if you've bought at a 4% yield with a 50% leverage and it goes to 5% yield, what has traditionally been considered the safe end of our market, you're looking at some significant principal loss. And that, I think, for a lot of us who are fundamentals investors, while we don't see that happening imminently, it is something as a long-term investor that is definitely a risk that is building underneath the real estate market, particularly in the core side of the market.
Andy, let me turn to you.
Yeah.
How do you see it? Paul spoke about, being a relative value investor. It's still an interesting asset class. Agree or disagree?
Yeah. No, I certainly think that from a real estate part of the business, it's certainly a very good problem that we're having right now. As you know, I'm with Generali Group. We are Fortune 50 company. We are a global insurance company. And our primary objective for our investment is really to match the liability of the assets that we invest in. So we do have fixed income, equities, and I'm on the real estate side of the business. Increasingly, we are feeling also there's been a lot of allocation towards real estate, the private market part of the business, and finding superior risk-adjusted returns in terms of getting into private structured products. So I think this is really what is happening globally, and we are really in this ultra-low interest rate environment. The key question is always, the point that's been made is it lower, longer, right? Are we lower, longer? Do we really believe in that? Where's the inflection point? I think everyone is really trying to understand where's the inflection point. Or do we think that structurally we are going to be, lower, longer? And of course, on the flip side, there's already signs that Fed may move up interest rate, and also China is playing a very big position in terms of what's happening globally. So I think where we are is that ultimately, from our point of view, we are still real estate fundamental investors. We need to be very, very mindful that at the end of the day, real estate investors are really looking at demographics, really looking at what are the drivers, because we are there for the medium term to the long term. We are not a momentum investor. So I think we have to look at it from different perspectives. What sort of style are you looking for? Are you opportunistic fund manager? Are you a momentum investors? So are you there for the medium to long term? So that's something that is very important, vitally important, because that determines how you see that instrument compared to another instrument. So I think when we look into how different parties invest across Asia and also globally, it's very important to understand their style. So the style will determine how they look at pricing all the assets differently. So, a lot of comparables are in the market. So when we look at in the comparables, why is this investor pricing it that way? Understanding the investment style of invest is ultimately very important. Yeah.
Well, Andy, obviously, the ECB has had a huge influence on the prices of all financial assets. Would you say real estate in Europe reflects fundamentals more, or the policies of the ECB today?
I would say at this point in time, it's actually a balance of both. Policy
50-50.
Yes, correct. And don't forget, Europe is also very much impacted by what's happening in the US. I think, the central bankers are really looking at one indicator, which is interest rate. And everyone is balancing and finding where the sweet spot is. And this interest rate ultimately determine how we, the asset allocators are struggling with this. And this is something that's very real. And at the same time, we know that China is also rising up in a certain way in terms of setting, the sort of new world order. Where are we heading towards ultimately? So I think that's fundamentally very important when we look at that aspect of it.
So now I will turn to you, Shimizu-san. Andy mentioned demographics. Japan is arguably one of the most interesting markets because we have seen the BOJ very aggressively buying up REITs. Many people expect it to announce even more aggressive purchase of REITs, yet the demographics in Japan are not all that attractive. To what extent do you think that the real estate market in Japan has become artificial? Is it a danger for an investor like Japan Postal Savings, a very long-term investor?
Yes, actually, BOJ monetary policy push or change the market cycle, obviously, and the I think lower, longer is correct for Japan, but at the same time. We are more focused on the very specific area about Japanese real estate opportunity. And I think one is urbanizations. Urbanization is, for 5 or 10 years, the Japanese population is decreased. But in the same time, the population is correct to the specific area. And in the specific area, we have a very good opportunity because urbanization create a new building or new area. And I think that kind of good area extracts talented people or good people. And also in the Japan case, Japan has a very, very good cuisine. And good cuisine extracts good people also. And the investor think about is how what kind of area the investors should do, I think.
Thank you. Johnny, final question for you. Paul mentioned the risk of what happens when interest rates do go up. When you look at real estate on a risk-adjusted basis, how do you think about that risk?
Okay. Generally agree with the commentaries by all the panel members. Now, what is missing in that whole equation is one, I strongly believe that real estate, unlike other financial assets, for example, bonds, right? You can do something with the real estate. You can create additional value add, right? So when we're looking at the risk of interest rate increase or the potential risk of interest rate increase, the impact will differ depending on how much leverage you have, whether or not you have been able to increase the income of that real estate, right? Or have you done other elements to basically create, right, an economic moat around that asset, right? And generally what people are thinking that, oh, you know, real estate core is core, value add meaning I'm taking more risk, and opportunistic, I'm taking extra risk. But what I would like to caution people is that, look, if you have an underlying asset with a stable income profile, say you have leased the entire building to a AAA tenant for 20 years, right? Let's assume a hypothetical assumption here that you leverage it up to 70, 80, 90%. Wouldn't you think that the risk of that asset changes, right? And going back to your original question, on a risk-adjusted basis, how do you look at real estate? Then what I'm trying to encourage all the participants here today to look at real estate risk not only from a single faceted angle. Generally, when people look at the risk, what do they look at? They look at leverage, they look at, you know, your lease profile, right? But there are other element of risk that's there. That's what Shimizu-san mentioned. You need to understand the underlying demographics, because at the end of the day, right, real estate is a derived demand, right? People need to be able to use it. And you need to understand all that. So the final message is that, look, I personally do not believe that there's a big macro tailwind for real estate. All the opportunities that you can find today are all idiosyncratic. And you have to do a lot of bottom-up analysis to be able to unearth good value, right? If you're just trying to play macro and say, oh, you know, I believe that China is going to go up, I believe Japan is going to go up, more likely than not, I think you will be disappointed.
Thank you so much. We've been talking about real estate more from a relative point of view. Now I would like to ask you all a question that I asked Mike Milken this morning. And before I ask my panelists to answer it and tell you what Mike Milken's answer was, I'd like to put that question to you. Raise your hand if you think a better investment opportunity is to purchase a luxury residential real estate tower in Singapore or a 30-year US Treasury. Who would rather own the residential tower in Singapore? Raise your hand if you'd rather own that.
That's very comforting.
Who would rather own the 30-year Treasury? Raise your hand. Very interesting. Very interesting.
Good news.
Now, when I asked Mike Milken this question, his first question to me was, how much leverage can I put on that investment? So let me start with you, Paul, once again. Talk to us about the supply and demand of leverage in the world. Is it available? Is it a good thing to use leverage? And what would your answer to that question be?
Well, starting with the answer to that question, I mean, obviously, as a real estate investor, the answer is always it depends on how much I have to pay for that building. Today, yeah. But I think if you're taking a 30-year view, the one thing that I always like about real estate versus, you know, other asset classes, and look, I'm a real estate person, not a fixed income person, so I'm always going to favor real estate. But the great thing about, you know, places like Singapore, New York, Hong Kong, is generally speaking, it's very hard to add land. And so you're buying a scarce asset, which I think over a 30-year period, as long as you believe that Singapore remains an attractive place for people to live, work, and play, owning a scarce asset is better than owning an asset that can be inflated or deflated at notice. So I think I'd always prefer the real estate investment. In terms of the credit, and it kind of goes back to the first question you asked me, and it kind of goes to what Johnny was saying about idiosyncratic opportunities. We talked about core real estate at the beginning and the flows of capital into core real estate and whether that's attractive on a relative or absolute basis. In the credit markets, what's happening is there's really a tale of two markets, just as there is in the equity market. And you're seeing the impact of the regulations coming out of the post-crisis era where, I'm not going to get into whether or not this is politically the right thing to do or economically the right thing to do, it's just the reality we live with, is that the regulators and the legislatures have decided that they are no longer going to allow the banks to create risk in the economy, and particularly in the real estate economy. And so they look at, the regulators and the legislatures looking at the banks for their utility function and trying to ensure that the banks, as much as possible, are safe as utilities, whereas the bank shareholders are looking for double-digit returns on equity, which means they have to take risk. And so there's this constant, if you're the CEO of a bank right now, you're being, pulled between those two horns, if you like. The impact of that has been, if I own a building in New York City with a AAA tenant in a central business district, and I want 50% leverage, the banks will fall over themselves to lend to me. That's not hard to find leverage by any stretch of the imagination. There are, however, very large parts of the market that are building where leverage is becoming very difficult to obtain.
What are those areas?
So one of the huge areas right now is in the residential mortgage market in the U.S. If you're a self-employed person, and I'm not going to get into the details of this, but under the Dodd-Frank Act, it's become very difficult for banks to lend to the self-employed market. That's a $300 billion market. That's 20% of the overall residential market. And it's one of the reasons why home ownership, and there are multiple reasons, but this is one of the bigger ones, home ownership in the U.S. has dropped to levels we haven't seen since 1965, and some people are predicting that it gets to 1950s levels. So the banks have withdrawn from that part of the market, not because it's unattractive from a credit perspective or unattractive from a return perspective, but it's unattractive from a regulatory perspective. So that's a huge area of the market that's pulled out. Development, we have a program with a number of U.S. Residential developers. Owning land now or financing land is almost impossible through the bank market. So that's having an impact, again, on home ownership levels. Residential development, again, is something where it's very difficult to get financing. Turning to Europe, where you have banks that are, excuse the phrase, constipated with a significant amount of non-core assets that are in trouble, that is restricting their ability to originate new loans. Their balance sheets are effectively, much like Japan, their balance sheets are clogged with these non-core assets, and until they get rid of them, it's very difficult for them to become the oil that's in the real estate market. So, that's the kind of way we look at it. I think,
Thank you. So, Johnny, turning to you, do you like to see investors put leverage on real estate to get higher returns? Or does it make you nervous
Generally,
today?
no. Because, let me qualify that. Generally, no, but it depends as well. What is it going to be dependent on? First and foremost, if you put leverage on an asset, right, what do? You literally increase the volatility of that asset, and you also increase the probability, right, of what I call the tail risk, whereby the lender calls the loan, and then you're unable to repay that loan so that the lender will repossess your asset. How do we minimize those risks? First and foremost, just to give an example, if you have, say, a 10-year horizon, right, of holding period. If you finance it up to 70, 80% with 2 to 3 year loan, right, then you're creating trouble for yourself, right? This is a simple asset liability mismatch, right? If you finance it up to the high level and it's all floating rate, you're creating unnecessary volatility, right? But if you have a 10-year hold, you put 10-year debt there, all fixed, all hedged, no currency mismatch, then it's a manageable risk.
Thank you. Shimizu-san, let's turn to you. How big a part of the portfolio of Japan Postal Savings is in real estate? And how comfortable are you investing? And can you get leverage in Japan? And do you think it's wise to invest with leverage in Japan?
First of all, real estate investment is a very good investment from the viewpoint of the diversifications. And we put a small percentage, but huge because money is about $2 trillion. And
So what percentage?
I cannot mention about that. Yeah, I'm sorry, but and from the viewpoint of our strategy, we look obviously global. But we have a lot about the Japanese market. So the about 40% of the real estate exposure is, I think, domestic.
In Japan?
Yeah, in Japan, yes.
And the rest of it is in Asia, Europe, US? What kind of distribution?
Yes, globally, that means US, of course, Europe, of course, and Asia, of course, yes.
Thank you.
Maybe, Henny, I just want to share, I think from our point of view, there are many different sort of segment of the investors that we're really talking about here. For institutional investors, for us in Europe, one of the reasons why investors hedge or the amount of borrowing that is really from a tax efficient point of view, why they take leverage, and the currency exposure point of view, why they take leverage, is really as a natural hedge. Most of our European investments, we don't take borrowings. But when we come cross-border into Asia, that's where it gets tricky. It's a very natural hedge when you take borrowings, and also currency exposure. That's from an institutional point of view. But my sense is that given where we are, I think clearly my view is that a lot of Asian corporates, given the many multiple crises that we have been going through, I must say that we have never been well capitalized for most of the corporates here, as well as for individual. That's why you look at it, the government actually have been helping along. Even in Singapore, even in Hong Kong, even in China, there's been a lot of concern about overextending, investing into multiple investment properties. So I think from a government point of view, from a regulatory point of view, from a business point of view, because it goes back to, do we expect lower longer, right? At what point in time will the inflection point come along? So I think if you look at it, whether from an individual point of view, buying residential property, whether from an institutional point of view, I would personally feel that, in fact, from a leverage point of view, we are actually quite well protected, conservative, because of the multiple crises that have happened since 1998, the Asian financial crisis. Of course, you have the dot-com, you have the SARS, and most recently, you have the Asian financial crisis. And that's why a lot of corporates, even in Singapore, has been issuing sort of, medium to long-dated bonds, simply to ensure that they ride out as much of this ultra-low interest rate environment, because there's a concern at what point in time will it turn, and when it turns, it can be hit quite badly.
That's a great point. I wanted to ask you one other question. We'll talk about China separately as a market later, but let me ask you one other thing as long as we're talking about regulation. And to what extent do you see regulatory risk growing in this sense? I was having dinner last night with somebody who is resident in Singapore, but Aussie. He's been selling all his investment properties in Australia to Chinese buyers. We have seen my own country of Hong Kong impose stamp duty on non-residents who are buying. We've seen the same in Vancouver. Most of them are reacting to capital outflows from China into their markets. So you have governments which are taking political decisions saying housing needs to be affordable. You know, we don't see a lot of income growth among workers. You know, are these political measures, how do they influence how you think about real estate, residential real
Sure.
estate as an asset class? And will we see more governments sort of taking measures, you know, out of concern that their housing is no longer as affordable as it should be?
I would like to sort of paint this picture. If you look at it from a government point of view, they do look at it as political risk. But bearing in mind, the government is also, a lot of them have their own central banks. And I think that's where a lot of institutional investors are always looking at it. For yourself and a lot of institutions, there's always this single indicator, which is interest rate.
Yeah.
Central bankers are trying to find a sweet spot of what is the right interest rate at what point in time. And for a long time, you know, there's been always this speculation on when, at what point in time, Fed will move rates up. And I think
Or if, as Paul
that's
said.
right. And that presents a lot of volatility in the market. You can see the market has been volatile because there's a lack of direction. And I think that expresses the concern of the government because they are in the position of the central banker and they talk among themselves. But at the same time, if that is not well managed from a regulatory point of view when it comes to financing, loan to value ratio, the interest rate, it could come back and haunt, you know, because it's all savers' money. The individual owners of real estate, you know, and if asset becomes distressed, that's where they become a political issue. Yeah. So I would say that the regulatory part of the policy is very, very real, whether they limit the amount of borrowing you can on your second investment property or third investment property. The amount of stamp duty they're going to impose on you for your second investment is also another regulatory measure. So these are measures, you know, are developed to ensure that people are always mindful that the interest rate environment may turn. And if you turn, you are not unnecessarily caught into that situation.
Thank you.
Can I just
You know,
add
please add.
on that comment? Let's peel the onion further, right? If you look at some of the underlying structural issues, why are these governments imposing such a restriction, right? If you look at the banking sector, just take Hong Kong, for example. An economy that's literally tight with China, but its monetary policy, given the fact that Hong Kong dollar is pegged to the United States dollar, right, is
Yes, the
essentially
Fed,
the
not
US
the
policy.
HKMA,
So how do you
it's our central
manage
bank.
this two very opposing forces, right? Obviously, you cannot control that from the interest rate side because then you either have to appreciate or depreciate the Hong Kong dollar or break the peg, which is, you know, cause another set of problems on its own. So you need to impose some form of draconian measure, either additional stamp duty tax or, for example, in Singapore, ABSD, right? But the cases for Singapore, and I'll tie in Australia in this, is that the whole banking sector in Singapore cannot completely sustain itself from the depositors, domestic depositors. They need to borrow from the overnight market. So loan-to-deposit ratio is actually higher than 1. Because of this issue, you need to have some form of additional control. And for China, it's a completely different issue. It's a mismatch between the upgraders, the demand, versus what the construction companies or the supply can deliver. And my worry is that, you know, because of these imbalances, the government will always come up with some form of knee-jerk reaction to this or control. Right? Let's take China, for example, right? About, 12, 18 months ago, the government said, demand is way down, relax everything. Right now, things are moving up again. Shenzhen is one thing, Shanghai is one thing. They say, no, it's going too fast. Let's introduce, you know, measures again. So it's like constant, you know, restriction, relaxation, restriction, relaxation. That induces unnecessary volatility.
Yes. Before we get to China, I want to shift gears and talk about technology. You know, in the panel earlier today, you know, Apollo and TPG both talk about how they're getting into real estate as an asset class and diversifying into real estate, but they are tiny. You know, Blackstone, by contrast, real estate has been their best performing asset class, and they are huge. But if you look at a Blackstone, the kind of investing they're doing in real estate has changed largely because of technology. So Paul, let me start with you. How do you see technology changing what is attractive within real estate? You know, many people say, if we're going to invest in shopping malls, it's got to be a shopping mall with services rather than goods. People will go to a shopping mall for massage or dinner or theater, but they will not go to buy anything in the terms of goods because it's so much more attractive to do so online, especially in China. How do you see the impact of technology? What does it do to office investments, say? What does technology make more attractive? What does it make less attractive?
Sure. I mean, you know, it's one element amongst a variety of things that are changing in real estate. You know, whether it's the leverage that we've talked about. You know, this is one aspect. Both demographics and technology are changing. Definitely the way we think about real estate. You know, you mentioned retail. You know, retail has become, particularly in the U.S., a more of a destination, lifestyle type event. So if you look at where do the big retailers want to be, they want to be in places like Soho, New York, or they want to be in the big mega shopping centers. You know, this is going to sound awfully sexist, but you know, we did a shopping center in London, and we created sports bars and a place to go drive Range Rovers over rough terrain. And we figured out that the reason we did that was because if you can keep the man in the shopping center for an hour, you're generally going to have a 20% increase in the amount of shopping that occurs in that shopping center. So, you know, there are definitely changes in the way we think about retailing. In office, technology has changed dramatically the square footage that the average employee uses. So, you know, on average, and putting aside the law firms where it's even more dramatic, but on average, we're using a third yet less space per employee than we did 20 years ago. And part of that reason is we don't need filing cabinets. We don't need a secretary for every individual. People prefer, in many cases, to be in an open plan versus an office. And so we've seen a dramatic change in the utilization of office space. In our residential apartment buildings, millennials, you know, people that we're attracting 25 to 35-year-olds. On average, the type of apartment we're building for that age group is 30% smaller than it was 20 years ago, but significantly higher quality. The fit out is significantly higher, and the amount of common space we have to build now is much higher. So
will we have parking garages in 20 years, or will no one own a car and everyone just sort of car on demand, driverless car, and there'll be no parking garages?
You probably want to talk to the Uber guys about that. I know, like I think certainly in the urban environment, you know, the transportation issues. You know, if you look at what millennials in particular want to be closer to their place of work and closer to their place of entertainment, and don't see the need to own a car, and see a car as a commodity that can be rented when necessary. So certainly, I think we are changing dramatically the nature of how we think about transportation. You know, I was talking to somebody that does a lot of residential development in Mexico City. You know, the trend was 20 years ago to move out of the city into the more suburban environment, to get bigger space, to have better schools. What they're seeing now is effectively an elastic bounce back, because as you move further and further out, your commute time is getting bigger and bigger. You know, if you look at the number of cars that are being added to the Mexico City market on an hourly basis, the congestion is getting higher and higher, and so people are now starting to move back in to reduce their commute time. And there is a direct correlation between the amount of cars on the road and the distance that people are willing to live from their office. And so, you know, these are all things that, you know, it used to be really easy to be a real estate investor. You buy cheap, you know, put a little bit of leverage on and sell it. You know, we as real estate investors today need to think about central banks. We need to think about interest rates. We need to think about leverage and where it's coming from. We need to think about demographics. We need to think about the environment. I mean, one of the environmental issues are becoming significant. Real estate, commercial real estate contributes to 1/3 of carbon production, right? And so whether you believe in environmental change or not, it is highly likely that there will be some form of either economic or regulatory impact on commercial real estate.
Thank you. I'm going to cut you off there. And I'm going to turn to you, Shimizu-san.
Yeah.
Do you think the impact of technology will be more dramatic in emerging markets or developed markets? I mean, in a way, Japan is much better set up, with its strong public transportation.
Yeah.
You've had delivery services that are far more efficient than JD.com in Tuck You Been in Japan forever, right?
Yeah.
How do you see this question? Is technology going to reshape geographies more dramatically in emerging markets or developed markets?
Yes, I think both. And I think technology give a most very strong impact on the real estate investment because especially in the field of the logistics and for example the auto drive techniques dramatically change transportations and also auto drive techniques reduce the number of cars itself. And also VR techniques change the shopping motion of the people and what impact on the commercial space. And that's I look at AI or IoT things and that's a risk, but a chance, I think.
And how do you see this? Will technology be more dramatic in the emerging markets in your purview or the developed markets?
My view is that I'm actually very concerned about this technology disruption coming into our real estate domain. As you know, real estate has always been a private market. We have never been very, very good at information. That's why we are a private market. We are not like the public market, fixed income versus trans. So information has always been a challenge for real estate. And that's why in Asia, I chair the Asia Pacific Real Estate Association. One of our mission is really to ensure that at the G2G level, we try to open up the REIT market across Asia because that becomes a very good benchmark, for us to even price private real estate. But coming back to this aspect of technology disrupting real estate domain is something that I'm actually keenly very concerned about for a couple of reasons, because I think we, for many years now, we are still living in an era of excesses. Since the last global financial crisis, right, there's a lot of excesses. And then now we are, in terms of pricing, we are still back where we are. And I think this excesses has caused a lot of disruption, and technology are coming into this space to create efficiency in terms of the excesses, whether is it in terms of hotel, in terms of retail, and it's really breaking the stronghold a lot of the traditional real estate player in this market. And we're already seeing that in the hotel, and we're seeing that in the retail, in the shopping center. And it was just yesterday or the day, I was just talking to a CEO of a conglomerate here in Singapore. We were just talking about, look, given where this technology is disrupting our business, I would be very worried and concerned if this sort of new technology of sharing economy comes into the corporate office space. Corporate office space. And you look at it for major corporates who are major tenants in a lot of these buildings. And in this challenging environment of trying to push up the top line, companies are facing challenge growing their revenue. And two areas that they're trying to cut now is either in terms of labor cost restructuring, but a big significant part is occupancy cost. It's a huge part of the business. And if I'm a technology newbies into the market, say it's a very, very attractive proposal to propose to some of these big companies, look, I have this area whereby I could disrupt and ensure that you continue to move up your bottom line by significantly reducing your occupancy costs. I think these are the domain that we tend to be a little bit slow to react as a traditional real estate fundamentals, rightly or wrongly because of the mindset change. But really, we're talking about this sharing economy, this information flow, and the millennials are very good at it. And I do see that in the developed markets, it's a major risk, but the emerging markets are really at a point whereby they are also trying to grow their real fundamentals. So, they may be impacted maybe slightly later, but they will be impacted. It's a matter of just the timing, yeah.
Yeah, I mean, I think, as somebody on the older side, it's very hard to underestimate the mental difference between our generation and the younger generation. I think you're absolutely right. I mean, I think things that we take for granted, they do not take for granted. And so, whether it's car ownership, whether it's how you work, how you play, how you shop, there is a fundamental shift occurring, and it's incumbent upon us to remain on the front edge of that.
So, Johnny, I'm going to turn to you, and let's go back to China.
Yep.
And how do you see the China market? You talked about government policy, how it contributes to volatility in China. You talked about the fact that you cannot see China as sort of one market. How do you see China and the prospects there? And how do your investors see China?
Okay. A number of our investors obviously have read a lot of articles on Bloomberg and saying like, China is collapsing, it's coming down. Mm-hmm. But it's akin to saying that, just because the Detroit residential market is such in a sad shape that I should not be investing in more vibrant markets such as, the West Coast, LA, SF, or New York, right? China is not one country. China has different economic drivers and arguably because of that, different dynamics in their real estate market. So you cannot look at China as just one single country. That's number one. Number two, but however, if investors trying to enter China and saying that, look, I'm just going to look at the macro sector and just going to, basically invest in a carpet bombing fashion, then I think that
your point about idiosyncratic.
Exactly.
Perfect.
It goes
so where would you be most bullish? Where would you be most bearish in China?
Okay, because of the emerging market nature of China, generally for the Chinese investments, we'll generally prefer investments with arguably shorter duration, hopefully higher in cash flow priority. So let me try to explain that. What do I mean by lower duration? Lower duration means the holding period or the period required for you to get your capital back is quicker. So you can achieve that in many different ways. Residential pre-sale is one of them, for example, right? And then talking about...
Is that risky, pre-sales? I mean, how many people 20 years ago bought flats on spec? They were told the building would have 6 elevators, it has 1. They were told there'd be a swimming pool, there is none.
Well, first and foremost, this is not in India, right? In India, that would be a common occurrence. But in China, it's not that bad.
Anymore.
And
I think that's a good point, that the market is maturing now.
The market is maturing.
Yes.
Right? And if you look at the most recent apartment designs, particularly in the first tier cities in China, they are equally as good, if not better, than some of the more developed countries such as Singapore and Hong Kong. Okay, so the Chinese developers are learning up the curve very, very quickly. Right? And obviously, their exposure to overseas markets would just help improve that learning process. That's number one. Number two, the point that I'm saying in terms of being a bit more senior on your capital stack. I mean, for the last day or so, you've been hearing that what's the angle for China? I mean, distressed debt is one of them, right? I tend to view distressed debt as an interesting way to acquire the real estate assets cheaper.
Do you think China will move to, in the US when we first had auctions, in the bust 20, 30 years ago, you know, they started very low, and then as people gained confidence in the process, they rose. Can you see China actually moving to market clearing prices, especially given how important real estate is as collateral for so much of the banking system?
I think they have to, because it's not only related to residential real estate, right? China, generally speaking, the economy is going through a transformation whereby they're no longer just the global producer of cheap widgets, right? But rather they're transforming their economy into a more service-oriented economy. That means a large number of areas that, you know, former industrial areas will be useless and obsolete, and somebody needs to take ownership of those assets and reutilize that into a higher and best use, right? You can take an example of in southern China, Dongguan, for example, right? That has become the Detroit equivalent of China. So the government, given the immense size of that issue, the government cannot rely on the big four, right, asset management companies to clear out all these bad loans. They have to cooperate with the private sector to do that.
Very interesting. Let me ask all of you in the audience whether you're bullish or bearish about China. We just have slightly over 10 minutes left. After I see how you feel about China, I'm going to ask Andy, and then I'm going to take questions from all of you. Who is basically bullish about Chinese real estate? Raise your hand. And how many of you are bearish? So, Perry, you did not raise your hand.
I think I go by the line that there are multiple countries and markets. Be specific.
Thank you. Perry was working on the survey of the cities in China, so that was why I was interested in his view. Andy, what are the idiosyncratic opportunities that Johnny referred to that you see?
Yeah, I think, you know.
Many in our audience are agnostic.
Sure, you know. I think for a long time, you know, China, we all know, have been growing and growing easily for the last 15 to 20 years. And Singapore certainly has been, at least at the G2G level, we have been a great participant in the growth of China. And that's simply because it's driven a lot by massive investment, you know, into the whole China market. You know, and we know that for a couple of years now, China economy has been slowing down. And slowing down for good reasons, I would say, because structurally it has to evolve. Structurally, it has to evolve to the extent that it continues to be, you know, moving into a very consumer-driven economy. So I would say that people going into China now has to readjust the way they look at the returns that they're getting. Not just only for China, but if you look at globally, you know, because we are in a very different era right now. I mean, China, of course, has its demographics, has its urbanization story, has its population to really, you know, form a bedrock for that fundamental. But really, if you look at it globally, we are in an area whereby technology is making everything efficient. You know, pricing is being re-evaluated. So we are in an era whereby, you know, a lot of corporates are recalibrating their pricing model. And hence, we are at that juncture whereby interest rate will continue to be lower for longer. But going back to China, this is really what is fundamentally changing China, especially when we understand there are new technologies coming up in China. You know, it's moving a lot, not just while it's growing, but at the same time, the technology is also making China more efficient. I think that's something that we have to recognize that, you know, and as it moves structurally into a consumer-driven economy, the technology space, you know, entrepreneurs are coming out in China, whereby there's a huge marketplace in China, is also affecting the pricing model in China very rapidly. So I would say that from a volatility point of view, China will continue to be probably coming to a stage whereby it's supposed to be emerging up from an emerging economy to be a sort of more developed economy. So it will reach there, and it's a question whether do you buy into that story as it restructures into this economy.
You know, I was talking to somebody yesterday who's telling me that one of the shopping malls here is being converted into a hospital, another into a school. So, you know, changing demographics also has a big impact.
Just on that point, I mean...
Let me just see if, because we only have 8 minutes left, let me see if there are questions from the audience. Perry.
I guess I owe you an apology. I should make that line. I think, go back to the question you asked me. If we look at the perspective of large cities such as Beijing, Shanghai, Shenzhen, and so on and so forth, that many international or institutional investors are very familiar with. Those markets, I think they're going to go high, but construction less likely to be in large scale. So you make the point. The land supply is very limited. The price is not going to come down. Then go back to the demand side on housing. If you look at the coastal city, yes, they are somewhat oversupplied in the secondary, tertiary cities. But if you go to the countryside, you are talking about many, many people, probably roughly 40% of people in those areas live in housing that was built probably 40, 50 years ago. So that's where the demand will be, I think. So if you look at that kind of dynamic, then the market still have a way to run, but not going to be in large city, in my opinion.
Thank you. Are there any other questions? While you think of questions, I want to turn to a point that Shimizu-san made when we were talking before this panel. And you said, you know, one of the interesting dynamics is corporate governance in Japan and how that impacts the real estate market. Could you just explain that point?
Okay. Yes, the Japanese government tried to reform the corporate governance practice in Japan. And also they tried to fix checking up the institutional investor reform, and including the public pension fund. And two measures, I think, shaking up the old-fashioned Japanese economical system. And before that, the Japanese economy is driven by the bank deposit. All of the people's money went to the bank, and the bank provides a loan. And from the equity point, the cross-share holdings, broadly cross-share holding is executed. But two measures, I think, reverse that kind of debt-oriented chain to the descent, equity-like chain. And the corporate forced to hike, improve their ROE, and so they have to sell the asset, and also non-core business or something. That's why, from the viewpoint of sourcing in Japan, we will have a very, very good opportunity, I think.
Because more supply of land as corporations divest themselves of non-core assets. Any other questions? If not, I thank you all for your attention, and thank you to my panel for making my job such a pleasure, and thank you again to the Milken Institute for their hospitality.
Thank you.